APRA is ready to act if banks threaten credit availability. The chairman of APRA, John Longsdale, has said he's willing to adjust bank regulations for home loans in case of an economic downturn to prevent banks from limiting credit access and worsening the decline in house values. In Australia, we know credit growth and property prices are often correlated. When credit growth increases, it often leads to an increase in demand for housing, which can drive up property values. Conversely, when credit growth slows down or becomes restricted, demand for housing may decrease and lead to a fall in property values. This correlation is not always as straightforward as this and can be influenced by many various different factors such as the economic conditions, interest rates, and many other factors. But despite all this, APRA's chairman, John Longsdale, has said he's confident that the banks have enough capital to handle any potential house price drops of up to 20% due to the rapid increase in interest rates. Longsdale emphasizes that he's closely monitoring the housing market as it greatly impacts banks and the Australian economy.
Now, we've seen APRA do similar squeezes in the past. If you remember in 2017, APRA actually put restrictions on investor lending, and we noticed the property market came off the boils. So back in 2017, APRA put a few limitations in home loans for investor space to slow things down. They only allowed up to 30% of new home loans to be interest only. They only allowed up to 10% volume of growth of interest only loans above 80%, and did a few other things to slow down the investment market because there was a lot of speculation back in 2017 and the property market was running red hot. Off the back of that, things did slow down. So what APRA are now saying is they can use these similar measures that they used a couple of years ago to slow down the market to increasingly heat up the market. And we've heard similar rumblings from banks internally. I had a lunch over at Christmas with one of the bank's head of credit teams, and they were saying the bank was starting to make some lobbying and starting to make some inquiries about looking at reducing that servicing buffer that they increased from 2.5% last year to 3%.
Now, you might be thinking, why is this interest rate buffer that the banks use such a big deal? Well, think of it this way. If the current variable rate that you can get in the marketplace is 5%, the bank's actually assessing you whether you can pay a loan if the interest rate was 8%. So they add 3% on current interest rates. Now, this makes a big deal in your borrowing ability. As we've seen in 2022, we had 8 consecutive rate rises where the cash rate increased by 3%. This had a massive impact on borrowing ability because as rates went up, that interest rate buffer went up too and effectively reduced borrowing power by about 30 to 35%. So as we've seen every 1% increase on the cash rate, that's also meant borrowing power has reduced, and we've seen it significantly reduce in a very short period of time, which has had an impact on the property market. We saw at the end of last year, there was about a 7% drop in property values, and it's widely predicted that this year, the first half of the year, is expected for values to keep going down. 15% peak to trough is what some of the predictions out there are.
So APRA actually increased the servicing buffer in 2019 from only 2% to 2.5%. This was to help people cope with future interest rate rises. Then in October 2021, they increased it from 2.5% to 3%, where it's sat since. Now, APRA are really across this because they've even said that some of the statistics have implied that the implied buffer, so that 3% that should be in the background, actually was only 2.7% in the September quarter, down from 2.9%. So they're saying in the background, the banks are doing some things to sort of offset these servicing calculations. We've seen it with some banks where they'll use the lower of the 5-year fixed rate plus a buffer minus any discounts. So we're going to have to wait and see. It seems like there's going to be no broad brush approaches here, but definitely it sounds like APRA are ready and waiting if the property market does start to come off.
And to add to that, financial markets are predicting a 25 basis point rate hike for February as well as March before the Reserve Bank is set to potentially take a break, possibly with one more rate increase by mid this year. This could effectively take the cash rate from its current 3.1% all the way up to 3.85, as we've seen some of the banks predicting. This would take the cash rate to a level not seen since 2012. Meanwhile, as I talked about earlier, we've seen capital prices set to be projected further decreases in the first half of this year. And this is off the back of drops we saw at the end of last year, ending about 7.1% down nationally. And economists are predicting that we could see another 8% drop. So once again, we talked about earlier, the peak to trough is expected to range between that 15 to 20% in total decline. Now, Longsdale has stated that there is strong capital built up by banks since the financial system inquiry, and their focus on lending standards will allow them to handle any drops. He's emphasized the fact that there's unquestionably strong reforms at the heart of a strong capital framework. Now, Jaden, if we do see a change in these regulatory requirements, how will this affect the borrower individually on their ability to borrow from a bank?
The big but and the X factor here is going to be APRA. And if they see credit growth is slowing down, if it's outside of sort of system growth or where they want it to be, they can pull some of these levers where they might make it a little bit easier with the borrowing capacity method. Last year, we also saw the banks playing around with debt to income measures. A lot of banks limited your debt to income not to go above 6 times once you include everything else. So we might see them relax some of that criteria, which has been limiting a lot of investor growth. So I think it's one of those wait and see.
What do you think APRA is going to do? Well, leave a comment down below. And did you know here at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au, and we'll see you next time.